Here's something Wall Street doesn't want you to sleep on. Traders are actively pricing in another Federal Reserve rate hike, and they're betting it lands by October. That means borrowing costs, stock valuations, and your ETF portfolio could all shift, again. The Fed has already delivered one of the most aggressive tightening cycles in 4 decades. And yet, the market still isn't convinced it's over. If you've got money in the S&P 500, in bond funds, or even sitting in a high-yield savings account, what happens next at the Fed directly affects your bottom line. The question isn't whether you should pay attention. The question is, are you positioned correctly if they pull the trigger? In this video, you'll discover exactly why traders are keeping bets on a Fed rate hike by October, what the data behind those bets actually looks like, how a potential hike could ripple through the stock market and popular ETFs, and most importantly, what concrete steps you can take right now to protect and grow your wealth, regardless of which way the Fed moves. We're going deep on the numbers, the mechanics, and the real-world impact. Stay with us. Let's start with what traders are actually saying. The CME FedWatch tool, the most widely tracked gauge of market expectations for Federal Reserve policy, shows that a meaningful portion of market participants still assign a greater than 30% probability to at least one additional rate hike before the end of 2024. That's not a fringe bet. That's real money, real derivatives, and real positioning in the futures market saying the Fed may not be done. The current federal funds rate target sits in a range of 5.25% to 5.50%, the highest level since 2001. Even after a series of pauses, inflation has remained stubborn enough that the Fed has kept the door open. And traders are listening. They're not ignoring the Fed's own language. They're betting on it. So why does the market still believe another hike is possible? The answer comes down to one word: data. Core PCE inflation, the Fed's preferred measure, was running at approximately 2.7% year-over-year as of the most recent readings. That's still above the Fed's 2% target. Meanwhile, the U.S. labor market has remained resilient, with unemployment hovering near 3.9% and monthly payroll additions continuing to surprise economists to the upside. A strong labor market feeds consumer spending. Consumer spending feeds inflation. And persistent inflation is precisely the kind of signal that gives the Fed cover to raise rates one more time. The Fed has been clear, they are data-dependent. Right now, the data is giving them reason to stay hawkish. Now let's talk about what a rate hike actually does to the stock market, because this is where it gets personal for investors. When interest rates rise, the cost of capital increases across the entire economy. Companies that carry heavy debt loads see their interest expenses climb, compressing profit margins and earnings per share. Growth stocks, particularly in the technology sector, are especially sensitive, because their valuations depend heavily on future cash flows discounted back to today. A higher discount rate makes those future earnings worth less right now. During the 2022 rate hike cycle, the S&P 500 fell more than 19% peak to trough. The Nasdaq lost over 32%. That's the real-world cost of rising rates for equity investors. History does not guarantee a repeat, but it does offer a serious warning. Here's where ETFs come into the picture. Broad market ETFs that track the S&P 500, like SPY, VOO, or IVV, will feel direct pressure if equities reprice lower on rate hike news. Bond ETFs, particularly long-duration ones like TLT, are inversely correlated with interest rates. When rates go up, bond prices go down, and TLT has already lost significant value over the past 2 years for exactly this reason. On the other side, short-duration bond ETFs and money market ETFs have actually benefited from the high-rate environment, delivering yields above 5% in some cases. Sector ETFs matter here too. Financials, tracked by funds like XLF, have historically performed well in rising rate environments, while rate-sensitive sectors like utilities and real estate have underperformed. Positioning across these ETF categories is a critical decision in the months ahead. So what should you actually do? First, review the duration risk in your fixed income holdings. If you own long-duration bond ETFs, understand that another rate hike will likely push those prices lower. Consider shortening duration by rotating into short-term Treasury ETFs or even TIPS funds to hedge inflation exposure. Second, don't abandon equities entirely, but be selective. Quality matters in a high-rate world. Companies with strong free cash flow, low debt, and pricing power tend to hold up better when borrowing costs rise. Third, consider building or extending a CD ladder or Treasury ladder using direct purchases from treasurydirect.gov, where you can currently lock in yields above 5% on 6-month and 12-month instruments. Finally, keep adequate cash reserves. If volatility spikes around an October Fed decision, having dry powder gives you the flexibility to buy quality assets at lower prices. Don't be the investor who has to sell at the worst moment. Preparation is the only edge retail investors reliably have. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before making any investment decisions. The Federal Reserve does not move in a vacuum. Every rate decision ripples through the stock market, through ETFs, through mortgage rates, through your savings account. Traders keeping bets on a hike by October are telling you something. The easy money era is still over, and the path forward demands active attention. You now have the context, the data, and the framework to act, not react. The next Fed meeting is on the calendar. Will your portfolio be ready? If this video helped you see the bigger picture, give it a like. It genuinely helps this channel reach more people who need this information. Subscribe to YieldWire so you never miss a data-driven breakdown when markets move. And check the description below. We've linked tools and resources that can help you implement exactly what we covered today. Your financial future doesn't wait. Neither should you.